welcome back, everybody, to another episode of the Monday Mortgage Moment, where we're here to educate you about the different intricacies of the actual lending process when it comes to purchasing a home. We're here to talk about a topic that a lot of people like to ask me about. I get a ton of questions about, and that's investment properties specifically. So everybody wants to get into the whole real estate game. Everybody wants to be a real estate guru. So how do I get started? How do I get my first investment property? Well, there's several different ways. Once again, everybody's situation is not the same, but we're here to give you a little bit of information and let you know kind of how you can get into being an investment and how you can get that first property under your belt. Now, let's talk about the easiest way in order to do it. And that first way is actually to do it as a primary residence. All right. Primary residence is going to require for you to do a lot less down. Now, let's be specific. You can't purchase a primary residence as a one unit and then talk about kind of doing an investment property unless you plan on being there for a couple of years and then eventually leasing that out and then moving to another property. Specifically, what I'm talking about is I'm talking about multi-family units. I'm talking about anywhere between a duplex to a fourplex. Now, let's talk about the benefits of it. The benefits of it is that you have other tenants to help you pay your mortgage or pay your mortgage in total so that you're living completely rent-free. It just easily makes sense. So let me tell you about a recent deal that we did. The recent deal was the lady wanted to actually purchase a fourplex. She wanted to live in one unit and rent out the other three units. Well, the other three units actually paid the mortgage for her. So if she wants to move in a couple of years or 3 years or whatever the case may be, she can eventually move and then go ahead and lease out her unit, and she has her first actual investment property where it's cash flowing for her. So she could choose to stay there, live rent-free, and then just rely on her tenants to actually pay her mortgage for her while she steadily builds up equity with each monthly payment that she makes. The crazy thing is that, and I wouldn't call it crazy, but the benefit of it is that in order to qualify, if you purchase a one unit, there's only so much that you can qualify from a debt to income ratio standpoint. What a lot of people don't understand is that if you buy a multi-unit, you can actually use the rents from the other unit to qualify for that property. So now instead of you qualifying for $200,000, you add in those other rents. Now you can pay $300,000 for that investment property. That's what a lot of people don't realize. So that is a great added benefit in order to kind of get that first investment property under your belt. And what I tell a lot of people is the younger you start, the better you are, because everybody has friends that they want to have their own spot. When I get a fourplex, you occupy one unit, lease out 1, 2, 3 units, whatever the case may be, to friends of yours. Or you can choose to do complete strangers. Whatever is completely up to you. There's multiple ways to actually work it, but it's a great way to actually start. Now, let's talk about the different products. Let's talk about FHA and then conventional when it comes to primary residence. When you're doing an FHA loan, be sure that it has to be primary residence. You cannot do an investment property going FHA. It has to be your primary residence, which means it has to be a multi-unit. You have to occupy one unit. So there's one unit that has to be vacant for you to actually occupy for you to purchase that property. All right. So when you actually buy that actual property, it's still the same 3.5% down. You can still qualify for first-time home buyer programs. So not only are you using other rents to help qualify, now you can still use a program to help you pay the down payment and closing costs. Like it's to me, it's just kind of a little bit of a no-brainer if you're in a situation where you can do that. If you're single, you're married, no kids, that type of thing, it may be the better fit for you. If you have kids and stuff like that, it may be a little difficult. You may not want to put them in that type of situation, but it's completely up to you. All right. So when you're talking about FHA, it's still the same 3.5% down. Now, let's move to actual conventional. When you're talking about conventional and you're looking at trying to qualify for a property, you can purchase it as your primary residence again. And then you can use the rents from those actual other units to help you qualify. All right. So now let's move on to the next thing. Now let's move on to specifically just investment properties. That was way number one. Number two is just to buy an investment property outright. Now, remember, you can't go FHA, So FHA completely eliminates it. So we're strictly looking at conventional in order to get you inside that investment property. All right. So then now, if you're doing a one unit, then you're looking at a bare minimum of 15% down is what you have to put down. But when you do 15%, the mortgage insurance that we talked about in previous videos, you have to pay the mortgage insurance on that property. If you do 20%, there is no mortgage insurance. So what that means is it's kind of a somewhat of a difference between your cash flow. If you don't have to pay mortgage insurance, your payment is lower. So then your cash flow is more. So it makes more sense. But sometimes everybody doesn't have that 20% plus closing costs, plus escrows and all that other stuff to be able to make it happen. So that's way number 2. Way number 3 is hard money loans. Hard money loans kind of get a bad rap, but when you're looking at it from an investment standpoint, it's a great safe haven. Why? Because when you actually purchase the property, you're purchasing the property hard money in order to fix the property up. So now you're taking a property that you got for a discount because it needs some work, and now you're fixing it up to make it worth a lot more than what you actually paid for it. So when you actually go into it with hard money, you're in it for a month, maybe a month and a half in order to fix it up. And then after you fix it up, you refinance it into a long-term conventional loan where you're getting a lower interest rate. And then that's when you start to realize the actual cash flow of it. That's the part that makes sense. Everybody gets caught up on hard money because it's such high interest. But that's okay because you're only in it temporarily. But if you're able to refi and then you automatically have $20,000, $30,000 of equity within the property, it makes sense. Now you're leveraging the greatness of real estate in order to build your portfolio. If you purchase a property outright and you pay 15%, you're using your own money to build that equity. If you're getting into a property that you have to fix up, you're actually leveraging and creating that equity. So that is actually cash. That is actually cash money that you're actually getting into your pocket. You're not actually getting your money back from that 15 to 20% that you put down to actually purchase the property. Not to mention, when you're doing the hard money, you're purchasing the property below market value. Chances are, if you're buying a property outright and you're not doing anything to it, you're paying retail for that property. So that's something to keep in mind when you're looking at that. The third thing that we're going to talk about is if you don't want to go the route of hard money loan and then convert over to conventional. Let's just say you're like, hey, look, I just don't want to do hard money. I just want to go straight into it. There is a product called the home style renovation product. What that product is, it allows for you to purchase the property and then finance the actual rehab amount into the property to fix it up. And you have the same down payment. So essentially, let's just use for an example, you purchase a property for $70,000. You need to put $10,000 into it. Well, you take that $80,000 of the total project cost and you're coming to the table with 20% or 15% in order to pay for the down payment. Once you make that down payment, we're actually financing the rehab cost for you. So the new paint, the foundation, new fixtures, new plumbing, new electrical, whatever it is that you have to do to the property, you're financing it in and you're not coming out of pocket for it. But again, you're making that larger down payment in order to make it happen. That's the third way to do things. The fourth way is for a lot of people, they don't qualify for a conventional loan for one reason or the other, whatever the case may be. We actually have a product. Now, make sure you don't tell anybody this, but we have an actual product called the Investor Cash Flow product. What is the Investor Cash Flow product? It simply doesn't require any tax returns, any kind of paycheck stubs, anything like that. The way that you actually qualify for it is based off the cash flow that you're going to get from the property. So for majority of you self-employed people out there that makes $100,000, but you only report that you made $20,000 to the IRS, this is the great product for you because you can't qualify for a conventional. So let's just say, use the example that we use on number 2. If you get into a product with hard money and you actually fix the property up, you can actually refi into something long-term with lower interest rate and just solely use the cash flow from the property in order to qualify. So there's a lot of great tools out there, but it all depends on what your goals are and what your situation is. Not everybody has $100,000 in the account, right? But we got to figure out a way to kind of make your money stretch for you and be able to get you inside an investment property, which is what you want to do. You want to accomplish your goals. You want to start that portfolio in order to build cash flow or build financial freedom later on in life. All right. So those are the four main points that I would say to use when it comes to investment properties. Again, it's no one size fits all. Make sure you give me a call today. 832-297-7659. Let's talk about it. Talk to you soon.